adjustments. So let's jump over to this Tasty Trade platform and let's make some white space here. So if you are looking at a option chain, it's going to look similar to this. You can have calls to the left, you can have puts to the right. This right here is going to be the at the money line, the ATM. So if you're doing a roll up at the Dorian Trader, we are going towards the at the money line. That is considered the baseline, the equilibrium line for the Dorian Trader. We're either moving away from this line or moving towards this line. If you are doing a roll away at the Dorian Trader, you're moving towards the at the money line. So if you're on the call side, let's say you had a position here on the call side, this is your position. If you're rolling up, you're going towards the at the money line in this direction. If you're on the put side, to say this is your position on the put side, then rolling up is going in this direction towards the at the money line. Rolling up is going towards the at the money line at the Dorian Trader. Now, some people teach that when you are rolling the put side up, you're rolling up. And when you're rolling the call side towards at the money, you're rolling down because the strikes are actually going down on the call side, going in this direction, and on the put side is actually going up. But at the Dorian Trader, we teach the concept of just a roll away is going towards the at the money line. That is the equilibrium. That's the baseline. So you know a roll up is going towards the at the money line. So in return, the roll away is going away from the at the money line. So for example purposes, if we go here now and we add another option chain, calls are to the left, puts are to the right. This is the at the money line, the ATM. So if you have a position right here on the call side, a roll away is you're moving the position this way within the same expiration period. You're moving away from the at the money line, which is right here. On the put side, if this is your position, then you're moving away from the at the money line by going in this direction. When you're doing a roll up over here, this is a roll up, and this is a roll away. When you're doing a roll up, the deltas are getting higher. The delta is your position. You're going from a smaller delta to a higher delta. When you're doing a roll away, you're going from a higher delta to a lower delta. The lower the delta, the lower your risk. So a roll away is reducing your delta risk. All right, so when you're doing a roll out, it looks similar to this. So let's just put up two option chains again. Calls to the left, puts to the right, and then we're going to do an option chain here. Calls to the left, puts to the right. And so that just say this expiration is 0 DTE. That means it's 0 days to expiration, and this is where your position at. And I just say this one is 1 DTE. So this is going to expire in 1 day. So let's just say you had a position on the call side with 0 DTE going, and it was close to at the money, which is right here. And this is your position. If you're going to roll out, then that's moving from one expiration period, like this 0 DTE, to something later. So you're moving it to the 1 DTE. That is a roll out. And that's pretty traditional. Right? The way we're going to teach you how to roll out is not traditional, but the concept of moving from one expiration period to a later expiration period is a roll out. So at the Dorian Trader, for these short-term trades, we're normally going to roll out to the next day. But sometime you might have to roll out to additional 7 days or additional 30 days. It all depends on how bad the trade turns out based on the adjusting that you do. If you adjust at a high level, most of the time you're going to have to, the super majority time, maybe uh, almost 99 plus percent of the time, you're only going to have to adjust or roll out 1 or 2 days if you are adjusting correctly. So you want to learn the adjusting process. We go over the adjusting process in course 1, lesson 7 in the Dorian Trader School, but we're also going to go over it in some detail here in this course because it's important to be able to understand how to adjust. You have the three different type of adjustments. Now, now that we got the three different adjustments down, let's jump over to the option table here. And let's just say that you started a trade with 7 days to go and the trade becomes a problem with 3 days to go. Say your call side is the problem, and let's say you started with one contract. You can start with two, four, as long as you're starting with no more than 5K allocated to each contract that you start with. We talked about this in part one. If you're going to do one contract, then you're going to start with 5K. If you're going to do two contracts, you're going to start with 10K. If you're going to do three contracts, you're going to start with 15K and so forth. This is how you scale this type of strategy, this 7 DTE strategy. You're allocating 5,000 to every contract. So in this example, let's say you're going to do a roll up, and let's say your call side is at a very small delta, and you're going to decide to roll it up. So let's say your call side is here on the 4 delta and you have a 10-point wide spread on, because if you're trading the SPX, you're going to do a 10-point wide. If you're trading the ES, the 4/ES, you're going to do a 20-point wide. So in this case, using one contract, we're going to move up. And let's say we decided we're going to do a roll up. We're going to roll to this 10 delta here. If we roll to this 10 delta, keep it 10 points wide, and then we're going to collect another $60 here. And we're going to collect another $60 before fees and commissions. This is a roll up. We're going once again towards the at the money line. This is a standalone roll up. You're not touching the other side. You're just rolling up one side. You're going from a lower delta to a higher delta, and it should always be a credit. In this case, it's a $60 credit. Now, you can also do a roll up and you can add contracts. Sometimes you'll roll up and you will add contracts. On the Tasty Trade platform, you will highlight the new strikes that you want to add another contract to, and then you'll hit this quantity here, and that's adding another contract. So in this example, you would collect 145 if you did this. All right, so if you're going to do a roll away, let's just say your trade is something like this, and you want to do a roll away, then what you're going to do is buy back the position, because we're buying it back here, and you're going to move it. And let's say we moved it to outside of the expected move, so something like this here. And so that's going to be a roll away, and a roll away is always going to be a debit. It's going to cost you. So in this example, it's going to cost you 230. So when you are doing a roll away, you almost always are going to do a roll up on the non-tested side to pay for it. The tested side is the side you're having a problem with, that you are rolling away. And then you have the non-tested side that you're going to roll up to be able to pay for the adjustment of the tested side. So this is going to be 230. So in this example here, you would come up here and you would, and let's say the put side is the non-tested side here, and you're buying this one back 10 points wide, and let's say you're going to move it up. In this example, let's say you moved it up to the 18 here, and you did a 10-point wide. Well, that's only going to give you 150. So this is not going to be enough. To be able to get enough, you're going to have to move this trade to probably something like, in this example here, to like a 30 delta to be able to get enough. Okay? So keep in mind, when I'm doing this example, the SPX deltas are kind of moving this evening as the futures jump up. But I'm going to show you this again in just a second on the ES, so we can get exact numbers. But that's the roll up. When you do a roll away, you're going to use a roll up to be able to pay for the roll away. Now, a roll out is going to be something like this. Let's just say that most of the time you're going to do a roll out when the trade is at a 0 DTE, but I just say the trade is going really bad and you need to roll it out now, and it's 2 days to go. Well, normally you're going to buy it back, and your non-tested side, this is your tested side because it's in the money in this example. Your non-tested side is going to be most likely worthless, darn near worthless. So I'm going to disregard that. You're going to take that off, but it's going to be basically for no money. So this is your tested side. What you're going to see is you're going to see that it's going to cost you down. If it's in the money, you can't go by the extrinsic here on Tasty Trade. You have to go by this number here. So this is going to cost you as I say, after fees and commissions, 650. You're going to roll this out. And if you were going to roll this out, you're going to want to collect 650 at least in the next expiration period. So let's say we rolled it out to 3 days. And so what we would do is go to the tail end of the expected move, and then we would put on a 10-point wide spread, and then we would go to the 15 delta on the non-tested side and do a 10-point wide spread. And keep in mind, we need 650. So if we added another contract, we would get 750 here. So we would have enough to be able to do this. And we would be putting the tested side, which was the problem, just at the tail end of the expected move, so giving us better odds. And we're keeping the non-tested side no higher than a 15 delta, which is the green zone that we learned in part 2 of this 7 DTE course. Right? So that's the roll out process. So let's now go and look at this on the ES. So we're looking at this one on the ES, and it's the same kind of concept as the SPX, but I'm giving you an example on the ES now. So let's just say we had 3 days to go, and so this is trading right now. So we're going to be able to see this exact. This is going to be correct. So let's say we had a trade that was at the 49.85, and keep in mind the ES is 20 points wide. It's the same concept. You're allocating 5K to each one contract you do, but you're starting off with 1K of the 5K. Okay? And so 20 points wide equals 1K on the ES. So in this example, you're at the 46 delta and you want to roll it away. So the roll away, the cadence that you want is you want to move the trade outside of the expected move, right? At least the tail end of the expected move. So we are in the red zone. We had a 45 delta. We learned in part 2 that the red zone starts at 31. So we had a 45 delta. So let's just say we're going to move this to the tail end of the expected move at this 50.15. And that we're going to keep it 20 points wide. So it's going to look like this. And so this is going to cost us $205. So what you want to do when you roll up the non-tested side, in this case the put side, you want to roll it up to no higher than a 10 delta if you can. That is the cadence that you want. That's the rhythm that you want on the trade. The tested side, you're going to move to at least the tail end of the expected move, if not greater. The non-tested side, you're going to move to no higher than the 15 delta if you can. And most of the time you will not have to move it higher than the 15 delta. So once again, the cadence is that you're going to move the tested side to at least the tail end of the expected move, and the non-tested side no higher than the 15 delta. So in this example here, we're moving the call side to this 50.15, and so this is going to be the new trade. So let me break this down. This is going away, and this is going to be the new trade, because you're rolling away from at the money. This is at the money. You're going away from it on that call side. So now if we look at this, if we roll this away to the tail end, it's telling us it's going to be $200, $210. So after fees and commissions, maybe $220. So if we want to stay no higher than the 15 delta on the non-tested side, we're most likely not going to be able to get $220, $230 with just one contract. In this example here, we can only, if this was 100, then maybe we can get that at the 15 delta, most likely. But this is saying it's going to be 213, so we know after fees and commissions is going to be about 220, 225, something like that. So in this example, what we want to do then is use some of that ammunition that we put to the side. We allocated 5K to this trade, but we only used 1K to initiate it. So the trade went wrong. It's now at the 45 delta. We only used one contract at this point. So now we're going to add a contract. And so if we add a contract here, we're going to highlight it on the Tasty Trade platform, clicking on the middle part, and then we're going to hit the quantity here. And then that's going to give us 2 contracts. And that 2 contracts is now going to only going to cost $25. We're definitely going to be able to get that on the non-tested side because we're also going to balance out the trade by adding another contract to the non-tested side. So we can now move this away further from the the expected move. So now we're outside of the expected move on the Tasty Trade platform. This ruler here is the expected move. This ruler is the expected move. So that's how you know you're outside or at the tail end. So now we're at the tail end to a little bit more outside of the expected move. And so this is now costing us $78. So we know we're going to be able to get that. We're going to most likely be able to get 200 on the non-tested side because we're going to have two contracts and we're going to be around the 15 delta. So now I move here to the 17 delta, and so that's about 127. So we're going to stay right there. So in this example, we're able to move the call side, which is the tested side here, because it's the higher delta. We're able to move it from a 45 delta to now a 17 delta. So from the red zone to the lower yellow zone, right? So we made this trade a lot safer on the call side. And that's going to cost us, let's just say after fees and commissions, about 135. So now we're going to go to the put side. And the cadence is that we're going to buy it back and move it no higher than the 15 delta and add another contract because that's what we did to the call side. We added a contract. So the non-tested side in that case is most likely going to be a 1 delta, but let's just say it's a 2 delta. It's a 2 delta, 20 points wide. So that's going to be here. And then so what we're going to do is buy it back and we're going to move to the 15 delta, no higher than the 15 delta. So this is a 14 delta here. We're going to do a 20-point wide, and then we're going to add a contract. We're going to add a contract because that's what we did on the call side. And so we needed about 130 and we're getting 180 here. So we're going to be able to stay at that 14 delta, and on the call side, it's going to be the 17 delta. So we didn't switch the deltas. It's still higher on the call side. The put side is in the green zone. The call side is in the lower yellow zone. So if we decided to move the put side to the 12, then that's going to potentially be able to, we're going to be able to get it as well, but you're just going to get a smaller credit. But if you want to be further away on the non-tested side, then that's what you can do. So this is how you can add another contract. And that's the roll away process, right? So once again, the cadence of the trade is to roll the tested side to at least the tail end of the expected move. This on the Tasty Trade platform, this is the tail end of the expected move. This is the tail end of the expected move. If you get in this area, that's obviously greater than the expected move. If you get in this area on the call side, that's obviously greater than the expected, more than the expected move. The further away you can get, the better, but you have to be able to make sure you're not using too much of your ammunition. The risk of this trade starts mostly when it's 2 days to expiration or 2 DTE. That's where you need to be the most vigilant with this trade, and you're going to have to be able to adjust this trade correctly when you are inside of that 2 days to expiration. So if you start off with one contract and you can use up to 5, you want to try to come into this 2 days with at least 2 contracts left, but ideally 3 or more contracts left going into the 2 days to expiration, because that's going to allow you to be able to win on the trade 95+% of the time. You should be printing money on this trade darn near, as we said earlier, but the key is understanding how to adjust. So let's do this one more time. And keep in mind, if you're doing this in the SPX, it's going to be the same concept, right? I'm actually going to show this in the SPX again so we can make sure we're good. Let's say it's 2 days ago and you're in the SPX. Let's actually do the put side this time. So I just say you're at this 35 delta on the put side and you want to roll it away. So you're buying this back and you're going to go outside of the expected move. So let's say you're going to move it to the 49.20 here and you can keep it 10 points wide. So this is going to cost you $165. You have one contract on right now. So that means you're not going to be able to get this on the non-tested side, which is the call side, by staying by the 15 delta at this point. If it was 100, you can get it. This is 165. So in this case, let's just say we're going to add a contract. We're going to add another contract, and that's going to be $40. Right? So we know we're going to be able to get that because now we're going to have 2 contracts on the non-tested side. In this example, the non-tested side is now the call side. This is the non-tested side. This is the tested side, the problem side, the side we're moving away. So once again, we're getting rid of this trade here, and this is going to be the new trade. So now that we're definitely going to be able to get this because we can get at least 200 on the call side. So we're going to move this away and take it to a smaller delta. That's a 14 now. That's $80. So we're going to take this to a 12 delta. So that's going to be $110. So we're going to keep that at the 12 delta in this example, right? So we're moving from a 35 to a 12 delta. So from the red zone to the green zone here. And we're going to need, I just say we need $120. So what we're going to do is, let's say the non-tested side, which is the call side, let's say it's a 2 delta again, 10 points wide. So we're going to buy that back. That's what we're doing there. That's going to go away, and we're going to move it to no higher than a 15 delta. So in this example, if we move to the 15 delta, keep it 10 points wide, and then we add another contract because we're going to keep it balanced to what we did on the put side there. And so that's going to give us two. That's going to give us 260. We need about 120, 130. So now we can move to the 13 delta. That's giving us 200. So now we're even basically on both sides delta wise. So we move this to a 10 delta. This is giving us 150. So we can technically do it here, but in this case, I would probably go to the 13 and collect a little bit more, and then we'll be basically balanced on both sides. We'll be on the green zone on both sides at the 13 delta. So this is how you would adjust this. Now, if you had this same type of situation, I'm going to go to the call site now, and let's say we were at this 41 delta, and now we already had on three contracts, right? It's 2 days to go. We got three contracts on already. The trade has become a problem, and this is the tested side now, and we want to adjust it. So the cadence is that we're going to try to move it outside of the expected move. So in this case, or the tail end of the expected move to further outside of the expected move. So we're going to go to the tail end here, and this is going to be three contracts that cost us 390. We're not going to be able to get that on the non-tested side because we only got three contracts over there now. And so that means we're most likely to be able to get 300, not 400 that is trading at right now. So what we would do is then we're going to add another contract. We can add up to five contracts. So this is going to be the fourth contract. That's going to take us to 170. We're going to be able to get that because we're going to have four contracts on the non-tested side, which is the put side here. So then we're going to move this away then because we know we're going to be able to get at least about 400 on the put side. So that's 310. So that's where we're going to go. So it's 2 days ago. We're going to keep the call side at the 23, and that's basically cutting the deltas in half, going from a 41 to a 23, almost cutting it in half. And we're going to need 315, let's say 330 on the non-tested side, which is the put side in this example, to be able to pay for it. And we'll still have one contract going into the last going into one DTE to go, and then we'll have a zero DT. So in this example, what we would do, the put side was most likely going to be around a 2 delta. We're going to buy that back. It's going to be three contracts that we were on. So what we're going to do is go up to the no higher than the 15 delta. This is the 14. We're going to keep it 10 points wide, and we're going to add a contract here, and there we go, right? So we needed about 330, something like that. We're getting 390 here. So that'll be the 14 delta on the put side, and the call side was going to be about the 23 delta. So we're still going to be higher delta wise on the call side, but that's what we want. This is how you're going to move this, and you can adjust it all the way until you have five contracts. Now, if you were going to roll out, let's just go to 1 day in this example here. And as I say, we have a position here, but disregard that. Now, let's just say we had a trade that you wanted to roll out, and it's something like this on the call side, 10 points wide. And let's just say you had four contracts on, and let's say the put side, which is the non-tested side here, is basically worthless. So let's disregard that. But let's just say in this example here, you need about $1,700. You need $1,700. So what you're going to do is roll out. And I just say in this example, we're going to decide we're going to go out 2 days, from 1 day to three. So we're going to go out 2 days. What we're going to do is try to go to the tail end of the expected move again. So we're going to go here at this 25 delta, 10 point wide, and we had four contracts at that time. So we're gonna go to five contracts now. That's the max we can do. And then on the put side, we're gonna go once again, the cadence no higher than the 15 delta. For now, you could go higher if you had to, but that's what you're trying not to. So in this example, we said we needed about we said we needed about 15, 1600. This is 1700. So this would do it. And if you needed a little bit more, you can go to the 17 delta here on on the put side, and this will definitely give it to you, right? So now you're still at the tail end and expect to move at least on both sides, as you can see here, and that would allow you to still have some odds to win. It's not the greatest situation because you want to be further away, something like this on the call, on the put side and something like this on the call side, but this will still give you the probabilities on your side. Probabilistically, you still have the edge. This is a roll out. You shouldn't have to roll out until it's the until it's 1 or most likely 0 days to expiration. So that last day of expiration. And when you roll out, you're going to follow the same cadence. You're going to move to the tail end of the expected move on the tested side, and then you're going to move to no higher than a 15 delta on the non-tested side. And if you have to go greater on the non-tested side, you will. But if you can, most likely you're going to be able to go further away on both sides to get to a lower delta. That's what you want to. That's what how you want to operate and get to a lower delta. All right, so this is the adjusting that you want to understand. You need to be excellent at this. You need to understand the cadence. You need to understand how to add more contracts. And then once you've used up your contracts, once you've used 5 contracts, then you have to stop. Even though if you have more capital, you have to stop adding contracts because you're just going to add more risk and the market might beat you. So you do not want to add more risk. You want to be able to say uncle at that point, and then you just adjust the best you can without adding more contracts or increasing the width. You can increase the width when you're doing adjustments. So let's just say you have a trade like this and you have 1 contract and you decide that you're going to move it to the tail end of the expected move, and then instead of doing a 10-point wide, you decide you're going to make it a 15-point wide. You can, or 20-point wide in this example, or 15-point wide if you did this. You can do that. But the best type of way to be able to use most of your ammunition based on the buying power that you allocate into each contract is being able to stay 10 points wide on the SPX 70T trade and staying 20 points wide on the /ES 70T trade. So that's why I'm barely showing this process that you can increase the width of the spread, but that's going to require you to be able to, or limit you to being able to use less contracts. And if you want to be able to get the most premium, the only way you can do that is being able to use at least 5 contracts, or stand 10-point wide on SPX and 20-point wide on the ES. So we're now going to move on to the next video, and we're going to talk about proactive adjustments. Let's now discuss in this video proactive adjustments. Proactive adjustments mean you are on offense. You are dictating the pace to the market. What we just discussed in the previous video was defensive adjustments. You are reacting to the market. You are on defense. The market is dictating what's going on and it's forcing you to adjust. So you're either implementing a roll away or roll out, or maybe you're doing a roll up. Usually a roll up is going to be more proactive, but sometimes it can also be defensive. So let's jump into proactive adjustments. So let's start off by saying you put on a trade and it's in the SPX in this example, and you put it on with 7 days to go because it's a 70T trade. It's the next day and the call side is, let's just say the call side is at a 20 delta already, 10 points wide. You're buying it, you're going to buy this back. This is how it looks, right? You can potentially buy it back. So it's at a 20 delta. This is the yellow zone, as we discussed in part 2 of the 70T course. This is the yellow zone, so it's not a problem yet. You're just looking at it, being more vigilant, more watchful, more cautious of the trade. So in this example, this is the tested side, and I just say the put side is at a 2 delta. So what you can do at this point is just do a proactive roll up. You can buy this back, so this is going away, and then you can move it up to a 10 delta. When you're doing a proactive adjustment, you don't want to move the non-tested side most of the time no higher than a 10 delta because it's a proactive adjustment. So we moved it here, kept it 10 points wide. We're not going to add any contracts or anything like that. And then this is going to be $75 before fees and commissions that you receive. So that's an additional nice credit that you are receiving on the trade. So now your put side is going to be a 10 and your call side is going to be a 20. So you're just rebalancing the trade by just doing a standalone roll up. You're moving the non-tested side up. And usually when you do a standalone roll up, you're going to go no higher than a 10 delta. So you can avoid the whipsawness of the market kind of going back and forth in the big way. Now, another type of an adjustment is, let's just say, doing a proactive adjustment. Let's just say that you, once again, you're at this 20 delta again, and you decide you're going to actually roll it away some. You don't have to. It's in the yellow zone. It's in the lower yellow zone, but you're gonna or the mid yellow zone, and you're going to roll it away. So you can roll it away, and let's just say you just roll it away 5 points. You go from a 20 delta to an 18 delta. So nothing huge, but 5 points can be big for short-term trades. So this is going away, and then this is going to be the new trade, and this is going to be the new trade. So this roll away is going to, this proactive roll away is going to cost you, let's just say, about $35, $30 to $40 tops after fees and commissions, and you're moving from a 20 to an 18 delta. On the put side, we just realized that we can go from a 2 delta, and that's basically what it's going to be, a 2 delta. And I just say we decided to go all the way up to the 10, and we need about $30. So in this example, we're getting 75 before fees and commissions. After fees and commission, we're still going to get more than $30, and we just rebalanced the trade. We did a proactive adjustment. We are offense. So that's a roll away proactive adjustment. You're not going to do a roll out proactive adjustment. Right? Proactive adjustments are done within the same time frame of the trades. If you started with 7 days to expiration, you're going to do that proactive adjustment within that time frame. So another example of a proactive adjustment is, I just say that it's now 2 days to go to expiration, and this is the risk area. The most risk is 2 days or less to expiration, like we mentioned in the previous video. So if you are going to do a proactive adjustment, and proactive adjustment is anything that's not in the red zone is a proactive adjustment. So let's just say it's 2 days to go, and your call side is the tested side, and it's at a 16 delta, something like this. So you decide at this point that you can do a standalone roll up, like we just showed, or you can do a roll away. So let's just say you decide you're going to do another roll away because you're going into the 2 days to expiration. You're at 2 days to expiration. You're going to be going into 1 DT or 1 day to expiration, and you want to get your deltas as low as you can if you can, right? And let's say you already had 2 contracts here. So you decide that you're going to buy this back and you're going to roll it away. And let's say if you roll this away, this is going to be $60. Let's say after fees and commissions is going to be about $65. Okay? And just rolling it away 5 points. So you're going from a 16 from the beginning of the yellow zone to the green zone. So you're going from a 16 to a 13. It's going to cost you, let's just say, $65, $70. So then what you're going to do is you're going to go to your non-tested side. And let's just say your put side, once again, is a 2 delta. You're going to buy it back. You had 2 contracts. And let's say you're going to move this to a 10 delta. You move it to a 10 delta, 2 contracts. So you needed $65, $70. You're getting 120 before fees and commissions. So you're definitely going to be able to get the $70 after fees and commission. You're going to wind up with a credit. So this is a proactive adjustment. So now on the call side, you're the 13 delta. And on the put side, you're a 10 delta. So you're in the green zone of both. And now you're going into the 1 DTE. So you're being proactive, right? So now this one last kind of proactive adjustment I want to kind of get you to think about. Let's just say it's 1 day to go, and your trade looks like this here. Got a 13 delta on the call side. You have a 3 delta on the put side. So you decide that I'm going to buy back, and you got 2 contracts in this example. Let's say you're going to buy back and move your call side to the 9 delta. You're going to just be proactive. So that's going to be $45. So let's just say in this example, you decide, well, I'm going to add a contract here because I only have 2 contracts. I can use up to 5. It's 1 day to go. I'm going to take this during the last hour of trading. I'm going to take this, if you can, during the last hour of trading, I'm going to take this to a single digit delta. I'm going to add a contract. So now let me just do this example again because it's not showing that I have two contracts. So I'm going to go here and act like we got two, and then we're going to put here. Right? So we got two contracts. This is going to cost us $90. Let's just say $100, right? To move from the 13 to the 9. Right? We got two contracts. So what we're going to decide to do is add another contract. So we add another contract, and that's going to give us three contracts now. Okay, we got three contracts going into the last day. We started with one. We're now going to have three contracts going to the last day. This is going to be a small debit. So let's just say it's going to be $15 debit. So now let's go. Now let's go to the put side, and let's act like we have two contracts. And keep in mind that this is just an example. This is a 1 DTE trade, and we do 20 points wide on a 1 DTE trade, but this concept is still the same. On a 7 DTE trade, we're doing 10 points wide. So we have a course on the 1 DTE trade, and we teach 20 points wide, but the same concept of the proactive adjustment. So just want to show you that this will work. You need about $15 based on the adjustment we just did, because you just moved the call side about 5 points away to a single digit number. This is at a 3 or 4 delta, and so you want to move it up. So let's say we move it up to a, so actually we don't even have to move it up yet. We can just sell a new contract. That'll give us the $15 that we need. Right? But let's just say we do want to move it up. So we're going to buy this back, and it's two contracts. And so we're going to move it up. Let's say we just moved it up a little bit to a 6 delta, from a 3 or 4 to a 6. And let's say we kept it the same width of the spread. And so that would be something like this. And then we added another contract like we did on the call side. And that would give us $85 before fees and commissions. We needed about $15. So this will be a credit, and we'll be going into the last day where we're going into that 0 DTE process. That 7 DTE trade is now a 0 DTE trade, and we are at single digits on both sides. On the put side, or the non-tested side, we're at a 6, and on that call side, we were at a 9, I believe. So we're in single digits on both sides going into that last day, and we've used 3 contracts of the 5 that we can use. So we have 2 more contracts that we can use. These are proactive adjustments. So it's proactive adjustments are not black and white. They're definitely working in the gray area. So I'm giving you a framework of the proactive adjustment. Okay, a framework of the proactive adjustment, just like we gave you a framework of the reactive or the defensive adjustment in the previous video. All right, so this is the video on proactive adjustments. We're going to move on to the next video now on avoiding big losses. Let's now discuss avoiding big losses in this video. So we went over how to do a roll up, how to do a roll away, how to do a roll out. We talked about proactive adjustments. Now we're going to talk about avoiding big losses. So let's jump back over to the tastytrade platform, and let's go to 2 days to go for example purposes. And let's talk about that you are in a trade on the tested side. Let's say this call side is the tested side. And let's say it's at a 37 delta. You have a 10-point wide on, and you started with one contract, and you now have 5 contracts. And let's say your put side is at a 14 delta. And it looks like the trade looks like this. 5 points wide, looks like this. Okay? So this is your call spread. This is your put spread. You had a 14 delta on the put side, which is the green zone. You had a 37 delta on the call side, which is the red zone. So this is your tested side, and this is your non-tested side. But you can see it's 2 days to go, and you're inside the expected move on the tastytrade platform here. This is the ruler. This is the inside. This is the expected move based on this number over here. And you're outside it on the put side, and you're inside it on the call side. And so you've used up all your ammunition. You started with one contract, you allocated 5K, and you used 5 contracts. So that's using 5K in buying power. So now you want to avoid big losses. You don't want to have a $5,000 loss. The most you want to lose is 3 times the credit that you received. So let's just say you received $100 when you first did that first contract. 100 after fees and commissions, you had 100. So if you times that by 3, the most you want to lose is $300. Okay. And let's just say on this trade, you have a credit of $200. So you have a credit of 200. That's the credit. We're just going to say CR for credit. So you have, in this example, up to $500 then that you can lose to keep your trade within that $300 loss. So that's your cushion. That's your cushion. So what you can do at this point is say, I don't really want to move my put side up very much because that's the non-tested side. I want to try to stay outside of the expected move or at the tail end of the expected move. And my call side is a problem. So remember your put side is at the 14 delta, and this is your call side. So if you decided just to move this a little bit, it's 5 contracts, you moved it a little bit, you moved it to from the 49.75 to the 49.80. So you went from a 36 delta to 31. That's gonna be $225 before fees and commissions. Keep in mind you had $500 that you can give up, you can sacrifice, and still wind up only losing $300. Okay? So you can do that, and that will give you a little bit more cushion on the call side, and you can keep your put side the way it was on the 14. Or you can decide to, that put side was on the 14, you can move that put side up to, let's say, a 19. And you can see that this is not going to be great, but as I say, you just for example purposes, you're gonna have to move that 14, that 49.15 if we move to that 19. So we're gonna just move to the 17 here, and let's say you did that and you did 5 contracts. So that's gonna give you about $100. After fees and commissions, it's probably gonna be about $64, $65, I just say. Okay. And so you can use that to add to your already $200 in credit that you have. And then you can decide to move this call side a little bit more. So let's say the call side was like this, and then let's just say you decide you were going to move the call side to the tail end and expected move. You have 5 contracts. So you move the call side to the tail end expected move, or a little outside expected move, give yourself a little bit more cushion. And so this is going to be too much. So you can't do that. Maybe you can move to the 49.85. But what you're trying to do is reduce your risk by avoiding a big loss. Reduce your risk by avoiding a big loss, because if you can keep the loss 3 times the original credit or something close to that, you can get that back very quickly. You can get that back fairly quickly. You're going to have some down trades, you're going to have some down months, but it's not going to be often. So if you can keep the loss when you do have a loss small, and then that's going to allow you to continue to feel like you're printing money with this strategy. You want to avoid big losses. So in this example here, you can also decide to roll this out. This is the trade, and you can wait until the call side is darn near at the money, and then you can decide to roll out. That means your put side is basically going to be worthless at that point. And then you can roll the trade out. So for in this example purposes, let's just say you had 5 contracts, so you used up all your ammunition, and you decided to roll out at a 40 delta or even a 45 here. You decided to roll out. That's going to cost you, let's say, $2,100 after fees and commissions. So you decide that I'm going to roll out, and let's just say you decided to double the days. So well, actually that was 2. So let's just say you decided to go a little bit more than double. Let's say you went to 6 here because we don't have a 4. And as I say, once again, you decided to go to the tail end of the expected move. Let's just say in this example, you decided to go to the 28 and 10 points wide, and you got 5 contracts. And then let's say on the put side, you decided to go to the 15, doing that cadence that we talked about previously. And that's going to give you 1850. So that's not going to be enough. But if you move that put side up a little bit more, then that's going to be close. That's going to be a small debit. If you move that put side to the tail end of the expected move, then that's going to be also a small debit. because you needed 2100. But you understand the process here. But you don't want to go too much closer to at the money at that point, because you still want to have enough wiggle room to let the market move up and down. Okay? Move up and down. So in this example, you can also decide to go directional and get really directional, meaning that, as I just say, you think the market is going back up, and so you can decide to get a little bit more aggressive on your put side, and let's say you decided to went to a 30 delta here on the put side. Well, that's going to give you now a credit of about $400 that you need. It's going to give you a credit about $400. And so if the market continues to go up, that'll give you a lot more wiggle room, or give you some wiggle room on the call side, especially if you decide to move that call side outside of expected move, like something like that, because that's still going to give you a credit of $300. And if you moved it again, and then now that's still going to give you a credit of almost $200. So now you got the put side, you went directional, and you got the put side in this example at the 30 delta, and you move the call side because you think the market is going to continue to go up. Okay? And that's going up in this direction on the option chain. So to avoid big losses, you're going to have to be okay with taking a loss 3 times, 4 times, or even a little bit more than that, but you do not want a big loss. Do not want a big loss. So a big loss, in my opinion, if you started off with $100, a big loss would be something like anything over 500 would be a big loss. But the ideal type of loss would be no more than 3 times the credit you receive. So that'd be 300. So anything over 500 would be a big loss in this example, and you do not want that. You want to avoid that. So if you have to keep your trade outside of the expected move and put the situation in something like this, let's go back to the 2 days to expiration, and that's actually go to 1 day to expiration, and then just say you had a trade that is looking like this on the call side, and your put side, I just say, is at a 13 delta, something like this. So this is how the trade looks. You have 5 contracts, and so what you decide to do is that I'm going to keep my put side where it's at, and I'm going to sacrifice my call side some. So your call side was here, so I'm going to just show you this. Call side was here, so you decided, okay, well, I need to sacrifice my call side some. I got 5 contracts. Let's just say I had $200 in the trade. I got 5 contracts. I'm gonna move my call side to something like this, and so now I it's gonna cost me, let's just say, $875, and I had 200 in credit, and plus I didn't want to lose more than 300, and so that's 500 that I can lose. But if I decide to lose the 875, so that's going to be 875, so that's another 375. So basically, you're going to wind up in this example here is losing $675, because that's going to be $375 more than what you wanted to lose. Okay. And so in this example, that's going to be a big loss. We would consider that a big loss based on the example we said. So maybe you don't move to the 49.80. Maybe you move to the 49.75, and it'll keep the loss a lot more manageable. So sometimes you're going to have to sacrifice some premium to be able to keep the trade from having a big loss. And the best way to do that is to be able to understand how to do the 3 type of adjustments we talked about: the roll up, the roll away, and the roll out, and then understanding proactive adjustments, understanding when you should add contracts and when you should not, trying to keep as many contracts as you can going into the 2 days to expiration, because that's when you have the most risk. So you don't want to go into 2 days if you can avoid it with no ammunition and you already used up your 5 contracts, because any big move can potentially hurt you. You want to go in with 2, 3 contracts to go, and then that way, if it's a big move, you'll be able to still fix it if you start with 1 contract. Obviously, if you started with 2, then it's going to be a little bit more than that. If you started with 3, it's going to be a little bit more than that. You're going to have to make sure you're going into the 2 days to expiration, ideally with at least half the amount of contracts still to be able to use, to something very close to that. So if you started off with, let's say you started off with 2 contracts, then that means you can use up to 10. So going into this 2 days to expiration with still 5 contracts you can add, that's going to give you the odds on your side greatly. So you want to avoid big losses by all costs. And sometimes you have to sacrifice some of the premium and take some losses to avoid a big loss. All right, so that's what we wanted to discuss in this video on avoiding big losses.